Project Planning and Control, PPNC Planning and Baseline Architecture. Course 2, Module 2. Module 2, Budget Planning. Module 2, Budget Planning. Module 2 covers the annual budget cycle and how programs translate multi-year resource needs into phased annual budget requests that navigate the PPB process and reach congressional appropriation. You need to understand how to build a defensible phased budget, not just the PPB process framework. Curiously lacking formal training in this area is his observation. This module fills that gap. By the end of Module 2, you should be able to look at a contractor's phased budget plan and know whether the shape of the cost curve is defensible or suspicious, and explain why in terms a program manager can act on. Budget formulation is the annual link between the project's long-term cost and schedule baseline and the fiscal reality of congressional appropriations. Get it wrong year after year, and the program runs out of runway before it reaches delivery. By the end of this module, participants will be able to determine whether a program's planning products are fully developed, integrated, and ready for execution. The module examines the core elements of program planning, including work breakdown structures, cost estimating methodologies, schedule development, and earned value management planning. It also covers integrated baseline reviews, risk management practices, joint confidence level analysis, and contract management concepts that help ensure programs are realistic, executable, and aligned with performance objectives. Budget formulation is defined as the process of developing strategic budget guidance and planned budget authority for all labor, travel, procurement, and contracted services against program objectives. Budget formulation is continuous. Every time you are executing a budget, you are also building the next one. The execution data you collect this year is the foundation for the next year's requirements. Demonstrates responsibility for proper use of taxpayer dollars is the accountability framing. The budget formulation process is the mechanism through which programs justify their resource requirements to external stakeholders. Identifies issues and challenges is the early warning function of budget formulation. When the formulation process reveals that the funding profile doesn't support the technical plan, that's the moment to address it, not when the execution year begins. Budget formulation has 3 defining characteristics. It is multi-year and multi-tiered. It is impacted by annual appropriations, and it is continuous throughout the program lifecycle. Budget formulation occurs with every element of budget execution. This is the feedback loop. When a contractor underruns this month, that information updates your expectation for next year's requirement. The 2 phases are inseparable. Multi-year, multi-tiered, limited shelf life. This combination is what makes aerospace budget formulation more complex than corporate budgeting. The budget you submit in February is based on assumptions that will be 18 months old by the time the funds are available to spend. The PPB framework structures this complexity. It gives you a defined process for translating multi-year resource plans into annual budget submissions that can navigate the legislative calendar. It involves developing, assessing, integrating, and justifying all the funding requirements necessary for completion of the program/project/mission, assuring consistency with the schedule and technical milestones. R&D/aerospace business means our budgets are multi-year, multi-tiered, and have a limited shelf life, and often impacted by the annual appropriations process. Budget formulation is continuous. Budget formulation occurs with every element of budget execution. The budget formulation process is referred to as PPB. Planning, programming, budgeting, and execution, PPB, is NASA's 4-phase process for integrating plans, strategies, and priorities into programs, projects, and budgets. Planning and programming are where the substantive work happens, defining what is needed and translating it into resource requirements. Budgeting is the political and documentation process. Execution is where the dollars actually move. The four phases are sequential but overlap in practice. While you are executing this year's budget, you are programming next year's and planning the year after. The PPB cycle never stops. Each phase runs in parallel for a different fiscal year. PPNC professionals who understand all four PPB phases can contribute meaningfully to annual budget development, not just execution tracking. That capability makes you significantly more valuable to a program manager. The PPB lifecycle chart shows how budget formulation and budget execution relate to each other through the phases, with the formulation timeline, February to appropriation, spanning nearly 19 months. The 19-month formulation timeline is the practical challenge. By the time you receive appropriated funds, the assumptions embedded in your budget submission are nearly 2 years old. The world changed. Your budget reflects your past. Understanding which phase of PPB your program is in at any given time tells you what deliverables are due, what decisions need to be made, and which stakeholder reviews are approaching. The overlapping years, Year 1 PPB, Year 2 PPB, shown in the diagram illustrate why PPB is continuous. You're always working on multiple fiscal years simultaneously at different phases of the cycle for each. The planning and programming phases of PPB are detailed here. Strategic goal establishment, capability alignment, outcome identification, and translation of mission plans into prioritized, integrated resource requirements. Prioritizes and balances cost, schedule, and risk within fiscal limits. This is the difficult judgment call in programming. When the resource requirement exceeds the funding available, something must give. Programming is where those trade-offs happen. Produces a defensible resource plan for budget submission is the output standard. Defensible means supported by BOEs, consistent with the IMS and cost baseline, and explainable to external reviewers who will challenge it. PPNC's role in programming is to provide the integrated technical and financial inputs that convert strategy into defensible resource plans. That requires good BOEs, a credible schedule, and a well-quantified risk posture, all the products from Module 1. The budgeting and execution phases complete the PPB cycle by developing detailed budget submissions to OMB and Congress, implementing approved budgets, and measuring results. It feeds performance data back into future planning and programming cycles. This is the PPB feedback loop. Execution performance reveals where assumptions were wrong, and that information improves the next formulation cycle. Tracks obligations, expenditures, and performance metrics. These are the three execution tracking dimensions that Module 3 covers in detail. Understanding how they relate to each other is the foundation of budget execution analysis. Reports variances and corrective actions through PPNC processes. This is the integration point between PPB and the PPNC control function. EVM, variance analysis, and EAC updates all feed the execution reporting that informs the next programming cycle. This chart shows the multi-year budget cycle. Each fiscal year cycles through formulation, years 1 to 2, congressional action, and execution, with the stages overlapping across years in a continuously rolling process. The staggered structure illustrates why budget formulation requires a long-term view. What you submit in Year 1 formulation will not be available to spend until Year 3 execution. Assumptions made today will govern spending decisions 2 years from now. Formulation, advocacy, execution, audit/evaluation for stages per fiscal year, each with its own deliverables and decision points. PPNC professionals typically touch all 4 stages simultaneously for different fiscal years. The audit and evaluation stage is frequently overlooked in PPNC planning, but it is the stage that holds the program accountable for the commitments made in formulation. Close the loop, or you lose credibility for the next formulation cycle. The 19-month federal budget formulation timeline shows how agencies, OMB, the President and Congress interact from internal requirements development through appropriation to operating plans and execution. By the time appropriated funds reach the agency and projects, the budget assumptions are nearly 2 years old. For long-duration programs, this means the baseline assumptions at formulation time must be sufficiently conservative to remain valid at execution time. The passback and reclama process between OMB and agencies is where program budgets get compressed. OMB applies reductions. The agency responds with reclama justifications, and the negotiation determines final budget levels. PP&C analysts supporting PPB submissions need to understand which stage their data inputs are serving. Formulation documentation requires a different level of detail than congressional justification, which requires a different format than the operating plan. This transition question frames the budget phasing challenge. A multi-year program needs annual budget requirements, but without contracts and staff in place early on, the precise annual phasing is uncertain. Cost estimates and budgets for multiple years should ideally be based on required costs, the amount actually needed to do the work plus sufficient carryover. The challenge is knowing what's actually required when you're years away from execution. The phasing question is one of the most practically important in budget formulation. Underphased budgets create cash flow problems that delay contract actions. Overphased budgets create unobligated balances that attract congressional attention. There are historical models and rules of thumb that guide phasing when exact requirements aren't known. The beta curve and contractor phasing plans are the two primary tools, and both have their limitations and biases. The need for annual phasing stems from the annual appropriations process. Even a 10-year program receives its funding 1 year at a time, so each year's requirement must be justified and appropriated separately. An appropriately phased annual budget requirement is necessary to the success of the project. If the annual phasing is incorrect, the program may have more or less money than needed in a given year, disrupting execution. The President, through OMB, will approve or disapprove the funding plan based on the full run-out budget needs. This means the total life cycle cost, and phasing must be defensible, not just the current year requirement. Annual budget phasing is one area where PP&C's analytical value is most visible to external stakeholders. A well-phased budget that accurately tracks execution builds credibility. A poorly phased budget that consistently misses targets creates credibility problems that persist. Cost estimates for multi-year programs should be based on actual resource requirements, but early in the life cycle, before contracts and staff are in place, models and historical precedent must substitute for exact knowledge. The contractor is the subject matter expert on content and will provide the most accurate phasing plan. But the government must independently assess whether the contractor's plan is credible, and that requires understanding how development programs typically phase their spending. Cost phasing is very project-specific. General rules of thumb must be adjusted for the program's specific technical content, risk profile, and workforce ramp plan. A phase rule that fits one mission class may be wrong for another. The models and historical precedents that inform phasing are the same parametric and analogy tools used in cost estimating. Programs that have done rigorous cost estimation have the data to support better phasing. The general rule of thumb for development programs is the 60/40 beta curve. Approximately 60% of the budget is spent in the first 50% of the schedule, with the remaining 40% in the second half. Halfway point, 60% of budget, 40% of budget. This curve reflects the reality that development programs spend heavily on engineering, testing, and workforce ramp up early, with relatively lower spending during late integration and closeout. The 60/40 rule is a starting point, not a precise answer. Programs that front-load hardware procurement will have a different shape than programs that front-load engineering design. Know your program's actual cost driver profile before applying the rule. When the 60/40 curve is the right model, it tells you something important. If you are the halfway point and have spent only 40% of your budget, you are either underperforming technically or your early years were underfunded. The contractor's submitted phasing plan typically differs from the NASA estimate based on the 60/40th beta curve. Contractors systematically front-load their plans relative to what historical spending patterns suggest. The contractual process incentivizes front-loading. Contractors want cash flow up front, want to protect against overruns, and prefer to underrun a conservative plan. Understanding this bias is essential for evaluating whether a contractor's phasing plan is realistic. The gap between the contractor plan, more front-loaded, and the NASA estimate, 60/40th curve, is not inherently problematic. Sometimes front-loading is justified, but it requires explanation and validation. When reviewing a contractor's phasing plan, compare it to the beta curve and ask, what specific technical activities justify front-loading? If the answer is none, the phasing plan reflects financial strategy, not technical requirements. 3 mechanisms drive contractor front-loading: protection against overruns affecting award fees, cash flow generation, and the ability to disguise underruns by rolling through content. Front-loading means there must be steep ramp down on back end of schedule to make up for it. A steep ramp down is a red flag. It assumes workforce and contract activity can be reduced faster than reality allows. Underrunning a conservative plan can be disguised by rolling through content. This is the accountability gap. A contractor who systematically front-loads can show technical progress while spending money earlier than the work justifies, making overruns harder to detect. As a government analyst, your job is to flag plans with steep ramp downs and require technical justification for the workforce reduction and contract closeout assumptions embedded in the back end of the phasing plan. Sometimes a faster ramp-up genuinely enables more work to be accomplished earlier, but this only works for effort that can be accelerated by additional resources. Early design work and some technical investigations cannot be accelerated by simply adding people. There are many items where spending more money can accelerate, but there are also items that throwing money at cannot accelerate. Early design work is his example. More engineers on concept definition doesn't produce a better concept faster if the technical questions haven't been resolved. If planned ramp down is too aggressive and cannot be met, contractor is betting that uncertain nature of the project will cause changes to baseline. This is the get well strategy Bill describes. Don't accept it at face value. The test for aggressive ramp down is operational. Does the contractor have a specific, credible plan for reducing workforce and contract spending at the rate implied by the phasing curve? If not, the ramp down will slip and the back-end costs will be higher than projected. Cost estimating parametric models include phasing algorithms, beta curves, that distribute cost across fiscal years based on historical data and project-specific parameters such as milestone timing and spending peaks. Beta curves are calibrated to historical programs. They encode what real development programs actually spent year by year as a function of where they were in their life cycle. This historical basis makes them more reliable than intuitive judgments about annual spending. Based on historical data, and can be modified based on the amount of resources estimated to be spent by critical points in time. The modifications are where program-specific knowledge improves the generic curve. Know what makes your program's spending profile different from the average. The percentage of funds spent by the time the CDR is complete is one of the most useful intermediate phasing checkpoints. It is the point at which the design is committed and spending transitions from planning heavy to execution heavy. 4 beta curves illustrate different spending patterns by technical difficulty, complex versus simple, and production type, single copy versus multiple copies, showing how the shape of the curve varies with program characteristics. Most common for Flight HW is Curve 1, the aggressive front-load curve for complex, single-copy systems like spacecraft. This is the profile you'll see most often in major NASA science missions, and the one that produces the largest deviations from contractor-submitted plans. Most common for infrastructure is Curve 3, a more balanced distribution appropriate for facilities, ground systems, and support services. Applying a flight hardware curve to an infrastructure project, or vice versa, produces a phasing plan that will consistently miss execution. When evaluating a program's phasing, ask which curve applies to each major WBS element, and is the composite budget phasing consistent with that mix? Most programs have multiple curve types across their WBS, and the right aggregate shape reflects that diversity. UFE phasing requires intelligent allocation based on actual program risk and content, not formulas, not equal distribution across months, and not default in loading to hide reserves from budget reviewers. UFE/reserve should be phased annually based on project content and risks. The risk analysis from Module 1 drives this. Where are the high likelihood, high consequence risks in the schedule? That's where the UFE needs to be available. Utilizing historical precedent from closely analogous missions, historical data on where similar programs encountered unexpected costs is one of the best UFE phasing guides. If integration and test consistently produce overruns for programs in your mission class, reserve more UFE for that phase. UFE phasing is not a mechanical exercise. It requires the PPNC analyst to understand the program's technical risks deeply enough to identify when those risks are most likely to materialize and how much they will cost when they do. UFE has two distinct strategic purposes. Early UFE enables trades and risk reduction investments, while late UFE covers slips and overruns that occur near delivery. Early trades and investments can often help the project avoid major costs later. Early UFE is an investment in risk reduction. It funds the analysis, testing, and design iterations that prevent late program crises. Availability of reserves during late phases of development can help avoid further slips and cost increases. Late UFE is the safety valve that prevents a bad situation from becoming catastrophic. Programs that deplete UFE early due to early phase problems arrive at integration and testing with no buffer. The strategic UFE phasing question: how much early, how much late? Programs with high early technical risk should weight UFE toward the early years. Programs with high integration and test risk should reserve more for the back end. This transition slide moves to the practical budget development methodology, the 8-step process that translates program requirements into a defensible annual budget submission. Formal training on how to actually formulate a budget is curiously lacking. Most analysts learn by observation, which means they repeat whatever the previous analyst did, often without understanding why. The 8 steps provide a principled framework. Establishing credible budgets based on realistic spending plans is crucial to the process. This is the standard that the 8-step process is designed to meet. Each step is a check against the tendency to set budgets based on what you want to spend rather than what the work requires. A realistic budget plan is one that an independent reviewer with access to your technical plans and schedule would arrive at through the same process and reach approximately the same conclusion. That level of rigor is the goal of the 8-step methodology. Budget formulation is not simply adding inflation to last year's spend. It is a structured process that requires developing cost requirements from first principles, translating them into obligation and commitment needs, incorporating reserves, and comparing to available guidance. It is not simply looking at the previous year and adding 3% inflation. This is the most common budget formulation error. It perpetuates prior year assumptions without validating them against the current technical plan. The methodology is briefly presented here in 8 steps. The 8-step process is the course's most actionable budget formulation tool. Analysts who follow it produce budgets that can survive external review. Analysts who skip steps produce budgets that fall apart under scrutiny. The absence of formal training, as noted by Demmer, is a real gap in the PPNC profession. Many analysts with years of experience have never been taught the structure process. They've been doing it by feel. The 8 steps codify the discipline. Each NASA fiscal transaction moves through 4 steps: commitment, obligation, cost, and disbursement, and understanding this chain is a prerequisite to understanding both budget execution and the Anti-Deficiency Act. The 4 steps map directly to the budget execution roles introduced in Module 3. You receive and control money through commitment and obligation. You spend it through cost and disbursement. The critical distinction is between obligation and cost. Obligations are the legal commitment to pay. Costs are the actual work performed and billed. Both must be tracked separately because they occur at different times and have different significance for budget management. Programs that confuse obligation and cost make systematic budget errors, reporting spending that hasn't occurred, or failing to track legal commitments that will result in future costs. The 4-step framework prevents this confusion. This slide maps each transaction step to its purpose. Commitment reserves funds. Obligation legally binds the government to pay. Cost records were performed, and disbursement makes the actual payment. Obligations precede costs because you cannot legally incur payable costs without first obligating the funds. Cost without obligation is a violation of the Anti-Deficiency Act, one of the most serious program management errors. Disbursement, actual payment, typically lags cost by 30 to 90 days, depending on contractor billing cycles and government payment processes. This lag means cost carryover is always present. Plan for it. Do not be surprised by it. Understanding this 4-step chain explains why obligation plans must run ahead of cost plans, why forward funding is needed, and why unobligated balances are a management concern, all of which are analyzed in Module 3. Step 1 of the 8-step budget formulation process. Receive, study, and understand guidance from the agency, including the budget authority amounts provided as allowances or challenges for current and future years. Guidance comes as both budget allowances, what you're expected to work with, and challenges, reductions the agency wants you to absorb. Knowing the difference determines whether your response is a justification or a request for relief. PPB process outcomes will be provided. This means that by Step 1, the strategic planning and programming phases of PPB have already produced the multi-year profile that your annual budget submission must fit within. Step 1 is about orientation, not analysis. You are gathering the context that will govern all subsequent steps. Programs that skip this and jump straight to cost development produce budgets that are technically correct but do not fit the institutional framework. Step 2 develops the project's annual cost requirements by fiscal year, starting with direct costs from contracts, civil servant labor, travel, and purchases, using all available tools including 533s, EVM analysis, and cost models. Work with requirements owners, technical managers. Apply learning from previous performance. Adjust for changing expectations / timing of needs / your own analysis and expectations. This is not a mechanical calculation. It requires technical judgment. Adjust for changing expectations is where the BOE and technical plan updates are integrated. If the design has matured since the last budget submission, the cost requirements should reflect that maturation rather than preserve stale assumptions. Step 2 produces the cost baseline that all subsequent steps build on. If the cost requirements are incorrect, Steps 3 to 8 will produce a budget that appears internally consistent but doesn't reflect the program's actual resource needs. Once cost requirements are established, Step 3 translates them into obligation needs by fiscal year, accounting for the procurement lead times required to place the work under contract before the costs are incurred. Different procurements require different time frames. Crossing fiscal years changes your annual budget requirements. A contract awarded in September with first costs in November spans 2 fiscal years. Both must be reflected in your budget plan. Total all obligations by FY. The obligation totals tell you when you need to have the money available to place under contract. If the obligation plan requires a $10 million action in September, but the budget is not available until October, you have a planning problem. Procurement lead time tables on the next slide quantify how far in advance of the needed costs the corresponding obligation must occur. This determines the right shape of the obligation plan relative to the cost plan. This reference table shows typical procurement lead times for different types of acquisitions, from simple purchase orders, weeks, through competitive acquisitions requiring full RFP processes, 1 year or more. Not only do you have to work with the technical managers, but also with procurement managers. The lead time table is the tool that connects the schedule, when do we need the hardware/services, to the obligation plan, when do we need to start the contracting action. Programs that develop cost and obligation plans without consulting the procurement office often find that their contract placement timeline is shorter than the required lead time, preventing them from executing the plan they've submitted. The lead times shown here are notional. Actual lead times vary by center, by commodity type, and by current procurement office workload. Know the realistic lead times for your program's specific procurement actions before finalizing the obligation plan. Step 4 converts obligation requirements into commitment needs, establishing when funds must be set aside in the financial system to support the upcoming obligation actions. By Step 4, commitments equals budget authority needs. The cost plan, obligation plan, and commitment plan are now 3 related views of the same budget requirement, each positioned earlier in time to account for the lead time between setting aside money and actually doing the work. Time period between setting the budget aside for execution and the actual obligation. This gap is real and must be accounted for. Programs that treat commitment and obligation as simultaneous events will consistently find their commitments are behind plan. After Step 4, you have 3 time phase plans: cost, obligations, and commitments. In general, commitments will be the largest annual number, obligations somewhat smaller, and cost smallest. If these relationships are inverted, something is wrong. Step 5 incorporates reserve or contingency funds, UFE, for known unknowns, ensuring that the budget plan includes a sufficient buffer for identified risks and those that will inevitably emerge. How much reserves to carry depends largely on project performance to date, risk analysis, program requirements, stage of completion, etc. The 70% JCL requirement sets the floor for UFE adequacy. If your reserves are insufficient to achieve 70% confidence, you do not have enough. UFE sizing is not arbitrary. It is informed by the quantitative risk analysis from Module 1, QRA, SRA, JCL. Programs that size UFE as a percentage of budget without conducting risk analysis are gambling rather than planning. 70% joint confidence level assessment is required at least once during project lifetime. This is the formal validation that your reserves are adequate. If the JCL shows less than 70%, either reserves must increase or the technical plan must be de-risked. Step 6 identifies existing unobligated and uncosted balances from prior fiscal years and determines how they can reduce the new budget requirements, avoiding the accumulation of excess funds that attracts congressional scrutiny. Often overlooked and part of the reason the agency got into such a large, unobligated, and uncosted position over the last few years. Submitting full budget requests while carrying prior year balances produces the appearance of poor execution management. Acceptable forward funding obligations is approximately 8 to 12 weeks, depending on the nature of the project and contracts. This is the standard for carryover adequacy. More than 3 months of forward funding generally indicates either excess budget or insufficient execution. The carryover calculation is simple arithmetic with significant policy implications. Know your prior year balances before submitting new budget requirements, and document the carryover assumption so reviewers understand how the total was derived. Step 7 compares the total derived budget needs against the agency guidance received in Step 1, identifying gaps where additional funding is needed and opportunities where guidance can be met or exceeded. The budget position will be a joint decision by technical and resource management. The program's budget position is not just a financial document. It reflects the program's technical judgment about what the mission requires and what it cannot be done without. Justify. Weigh all options. Request additional dollar or reduce requirements. Identify any guideline budget allowance, which can be made available to project reserves. Step 7 is the negotiation step, and it requires both analytical rigor and institutional judgment. Baseline assumptions and document decisions. Replan following final decisions. Step 7 produces the program's documented budget position, which becomes the historical record of what was assumed, what was agreed, and what risk was accepted. Step 8 adjusts the budget submission for agency, OMB, and congressional decisions, develops monthly phasing plans for the upcoming fiscal year, executes the budget, and feeds execution learning back into the next formulation cycle. Apply to formulation what you learned during execution. This is the feedback loop that makes each PPB cycle more accurate than the last. If you pay attention to where your execution assumptions were wrong, you will not repeat those errors. Monthly phasing plans developed in Step 8 are the execution baseline for Module 3 analysis. They define what you plan to spend each month, which is what you'll compare against actuals in the cost plan variance analysis. Step 8 is both an end and a beginning. Completing it closes the formulation cycle. Starting execution opens the data collection that will inform the next formulation cycle. The two processes are continuous and inseparable. Budget formulation is an annual cycle. As soon as one PPB cycle completes, the next begins. This is not a project with an end date. It is a continuous institutional process. It is not simply looking at the previous year and adding 3% inflation. This reminder, placed at the cycle restart, reinforces the discipline. Each cycle should rebuild requirements from first principles, not just inflate prior year numbers. Programs that treat annual budget formulation as an administrative exercise produce budgets that drift from program reality over time. Programs that treat it as an analytical discipline produce budgets that remain credible throughout the program lifecycle. The continuous nature of PPB means analysts who master budget formulation are always needed. There's no slow season. Developing this competency early in a career creates sustained value across the full life cycle of multiple programs. The Module 2 summary confirms 3 key learning points. PPB is the process. It is iterative, and credible budgets based on realistic spending plans are the output standard. It is an iterative process providing clear communications at all stages. Budget formulation is not a one-time submission. It's a dialogue between the program, the agency, OMB, and Congress, and each exchange must be based on current, accurate information. Establishing credible budgets based on realistic spending plans is crucial to the process. This closes the loop on the 8-step methodology. A budget that cannot survive external scrutiny is not credible, regardless of how accurately it reflects internal expectations. The Module 2 competency, building a defensible, phased annual budget, is one of the skills that separates senior PP&C analysts from junior ones. It requires technical knowledge, analytical discipline, and institutional judgment working together. 3 questions test Module 2 learning. Evaluating front-loaded contractor phasing plans, explaining the 60/40th beta curve and contractor bias, and explaining the Step 6 carryover requirement. Q1 answers should distinguish legitimate front-loading, early hardware deliveries, project wind-down, from problematic front-loading, unrealistic workforce ramp-down, budget inflation gamesmanship. Both answers require real understanding of execution dynamics. Q2 requires 2-part answers. Define the curve accurately and explain the bias. The bias explanation must reference the contractual incentives that drive contractor front-loading, award fee protection, cash flow, and conservative planning strategy. Q3 is the most actionable question. Step 6 prevents budget oversubmission, which is the most common PPB compliance error. Analysts who cannot answer it clearly do not understand how prior year funds affect the new year's requirements. Module 3 covers the mechanics of budget execution, From the four-step transaction flow through obligation management, cost carryover, WBS-based funds control, the Anti-Deficiency Act, and monthly cost plan analysis. Module 3 answers, how does the budget you built in Module 2 become a live execution tracking tool? The monthly cost phasing plan is the connection between formulation and execution, and understanding how to read it is the practical payoff. By the end of Module 3, the analyst should be able to review a monthly cost plan for any program. Identify the 4 patterns: front-loaded, back-loaded, straight-lined, steep ramps, and explain what each might indicate about the program. Budget execution is where analysis meets reality. The data is live, the variances are real, and the decisions matter. This is the environment in which PP&C analysts work every month for the life of the program.